Welcome back. This video has kind of two features that are important to establish up front. Number one, it's a mirror lecture from the last lecture where I talked about market-implied value of growth, introduced the concept of market-implied value of growth. And this is looking at the formulas behind determining what the market-implied value of growth rate is. So that's kind of feature one. It parallels the last video. But also important is there's some math in this video. It's not particularly hard math. It's literally sort of basic algebra at best, because I have to manipulate some formulas to get to a conclusion. Those of you that are math inclined, I'll pause long enough on each slide so you can see what I'm doing. For those of you that are not math inclined, in fact, maybe there's some math phobic people watching the video. I hope so. You don't need a lot of math in becoming a great investor. Don't get too intimidated by the equations. Please don't. The actual manipulations somewhat unimportant, but the conclusion's pretty cool. At least I think it's really cool. So if you're not math inclined, you don't like equations, kind of, ignore the slides and listen to the dialogue, the narrative. And then at the end, when I give you the big reveal, the punchline, maybe stop for a moment and see what we kind of come up with. And I think the implication is incredibly important, at least very pragmatically important. All right, so let's go. Enough of that introduction. All right. What I introduced last week is this idea, last video, I do these once a week, sorry about that. This idea that there were three, we'd already established two layers to the valuation stack: invested capital. Every company should be worth the capital that's invested in it. That's pretty straightforward. And then there could be this extra layer of value, which I like to call present value of competitive advantage. It exists when a company has excess returns. We can use the perpetuity valuation formula only if we think those excess returns will be stable over time, which is where you get the idea that that is a source. The source of that stability is a competitive advantage. In fact, it's a sustainable competitive advantage. Once we get through the rest of the valuation lectures, I think it's probably be two more videos, maybe three, we'll dive into a more in-depth read of competitive advantage, coming back to this blue, light blue, royal blue layer of value. And then last video, I really established the idea of market-implied value of growth. That's the value that's above and beyond the present value of competitive advantage. Now, when we get to competitive advantage, and then when we get back to a very specific focus on growth, I will show you that if you can't hold your competitive advantage, that light blue layer of value is going to erode because of competitive pressures, then there is no sustainable value of growth. And therefore, even if you have a market implied value of growth in the valuation, it won't hold over time, because you can't create value unless you can hold that excess return. I'll get into more detail in that issue, that constraint, as we talk about competitive advantage, and then also get into the growth lecture. All right. Now, just for fun, you can see we have red, blue, and green. We refer to this as the Italian cookie. I may use that reference throughout the videos going forward. Now, we don't have exact colors, but if you flip the Italian cookie and changed yellow for blue, we have an Italian cookie. All right, just for fun. All right, what I did show is the market implied value of growth for the S&P 500. And the blue part will always be a darker blue, will be your earnings power value. And market implied value of growth will always be green. As I said in the last video, I don't have invested capital for the S&P 500, so we're looking at earnings power value rather than invested capital and present value of competitive advantage. But still, we get to walk through it. I then showed that the market implied value of growth for the S&P 500 right now is at an all-time high, but it's at a very high level, higher than we saw in October of 2020. That's before rates started to go up. So it's kind of interesting in my mind that the current market implied value growth for the S&P 500 is so high. Now, I'm hoping some of you thought, how high is too high? Is 64% reasonable? It's higher than it's been for the last 15 years. It's higher than it's the 5-year average, the 10-year average. But how high is too high? And that's really the question I want to address with a new set of tools, the next layer of tools. All right, this is just that exact chart with the stacked bars. That's when I talk about companies, and whenever we talk about market-implied value of growth, I will almost always use a bar chart rather than a line chart. All right, so let's go see if we can figure out what the implied growth rate is. This is the market-implied value of growth as a percent of the S&P 500, and then this is a 15-year chart. You can see it as a historical comparison. But what I want to tease out is, can we figure out what the implied growth rate is? Now, this is going to be a long-term growth rate, not a short-term growth rate, but we'll get to some of that details in a minute. All right, so we do know we're going to start the beginning of the math. It's really simple. Again, please, if you're math phobic, don't get upset with the equation. And if you like equations and things like that, it'd be great to follow along. And if anyone thinks that somehow I've done something that I can't do, please send me a message any way you want, and you'll make me smart. I'll learn something. All right. We know definitionally that the enterprise value of a company can be modeled with something called the Gordon growth model, which is you take the NOPAT, and as we talked about in all the videos so far, that's kind of a steady state NOPAT. You get to pick the NOPAT. I almost always use the current run rate or this year's forecast, but whatever you want, and then divide that by R minus G. Now, it's very quick for those math inclined that G cannot be greater than R. And I tend to think of the cost of capital somewhere between 8 and 10% for most companies, some exceptions, or some higher than 10. And therefore, that would imply the growth rate cannot be higher than 8 to 10. And yes, that is a constraint of this model. However, we're talking about essentially a perpetuity growth rate, and therefore I don't have to worry about that because there's no such thing as a perpetuity growth rate above 10, above 8. So then the pushback is, well, then you're getting a long-term growth rate, which is kind of meaningless. No, I don't think so. It's very good for mature companies because that's what they're going to grow at. Their current growth rate is what they believe they can grow for a long time. And for less mature companies, we have other tools which I will layer on top of this when we get to the growth lecture. All right, so we can model the enterprise value as NOPAT minus R minus G. All right, great. And we know that earnings power value, using the perpetuity valuation formula, is NOPAT divided by R. So we have two equations so far. Enterprise value, NOPAT divided by R minus G, and earnings power value, NOPAT divided by R. All right. Now, if I take the first equation and just rearrange it, I get NOPAT equals EV times R minus G, just taking the R minus G and putting it on the other side of the equation. And if I take the second equation, earnings power value, EPV equals NOPAT, then I know that NOPAT equals EPV times R. The reason I'm doing that is because I now have NOPAT in both equations on the left side of the equation, which means I can eliminate it momentarily. The other equation we're going to need is that enterprise value minus earnings power value is our definition of market implied value of growth. So those are the three main equations I'm going to need as we go through this analysis. All right, so let's just take the first two equations. NOPAT equals enterprise value times R minus G, and NOPAT equals earnings power value times R. If I take those two and I put them into a single equation, then I know NOPAT equals EV times R minus G, and it also equals EV times R. So I can get rid of the NOPAT. I get rid of NOPAT. I now know that EV times R minus G equals EPV times R. Okay, cool. All right, now if I just manipulate this equation, I divide both sides by EV, I divide both sides by R, I end up with the equation EPV, earnings power value, as a percent of EV divided by EV equals R minus G over R. All right, keep going. Take R and put it on the left side of the equation. So I know earnings power value divided by EV. That's effectively what percent of my enterprise value is made up with my earnings per value, times R, my discount rate, equals the difference between R and G, R minus G. All right, I can then move that second R to the left side of the equation. I then have earnings per value divided by enterprise value times R minus R equals minus G. I want to get rid of the minus sign, so I have 1 minus earnings per value divided by EV times R equals G. So I've now defined G. Now I'm going to move this around one more time, but Edwin, so I have now gotten G as an isolated variable. I know exactly what that market-implied NOPAT growth rate is. It's equal to 1 minus the percentage of enterprise value that's made up of your earnings per value times R. Let's clean that up a little bit. That means that EV minus EPV over EV times R equals G, just cleaning it up. And we know from earlier that EV, earlier videos and earlier in this video, that EV minus EPV, that's your market implied value of growth, MiVoG. And so we can substitute that in the equation. And we know that G is the market implied annual growth rate, which is effectively now market implied value of growth divided by EV times R. This is a huge, I think, breakthrough. I've been thinking about growth and growth investing for a very long time. I was co-author of a book with Jeff Moore called The Guerrilla Game, which is my first foray in trying to understand growth. We talked a lot about tornadoes. We talked a lot about market dominance and things like that, hyper growth. And since then, I've been working on this problem for, I don't know, do the math, I guess 35 years, give or take. And it wasn't until fairly recently that I actually figured this out. So this to me is a really cool breakthrough. We know that growth, the long-term NOPAT growth, I'm going to come back to that a lot, NOPAT growth, earnings growth equals market implied value of growth divided by EV times R. Another way of saying it is the percent of your valuation that is made up of your market implied value of growth. That percentage times your discount rate equals your growth rate, long-term growth rate, NOPAT growth rate. This to me is really pretty cool. So market implied value of growth rate is equal to that market implied value of growth as a percent of EV times your cost of capital. Now, when I figured this out, not been that long ago, frankly, this was really powerful. And as I start to play with the tool, I find it useful every day. Every time I look at a company, we're going to do some cases here in a couple of weeks. When we use this tool, it's, I think, incredibly insightful. So I'm really excited about this concept, very excited about this lecture. All right, so one more time, market implied NOPAT growth. Now, this is your perpetuity growth rate, which I think is a really cool baseline. Now, for faster growing companies, it's not as helpful in that sense, but you'll see in a minute that it's organic growth can be, if you will, you can compare your organic growth with this growth rate. And it's a very easy equation. That's what I love about it. Market implied value growth divided by enterprise value. Very easy to calculate. Times R, that's your implied growth rate, earnings growth rate. Now, that's a cleaned up earnings growth rate. It's a perpetuity growth rate, so it's a long-term growth rate. But I think incredibly valuable. I've never seen this before. Maybe somebody will write me and say, oh, no, somebody else has been talking about this for years. All right, so here's the market implied EPS growth rate for the S&P 500. And you'll see that right now it's at 6.2% perpetuity. In perpetuity, earnings growth rate for the S&P 500. What we're paying for right now is 6.2%, which I think is interesting to tease out. Now, what's really kind of cool is if you go look at October of 2022, when we were at the last peak, because rates were so much lower, the market implied growth rate was also so much lower. Remember, it's the market implied value of growth as a percentage of enterprise value times the discount rate. Well, the discount rate has gone up so much that the implied growth rate has also gone up so much. And the way you want to think about that is because rates are so much higher than they were back in October of 2022, the required rate to get the appropriate return is that much higher because rates are so much higher. So this chart tells a very different story than the chart where I show the two peaks in terms of percent of enterprise value that's made up of market implied value growth. Now the market implied value growth is very high, and the highest we've seen in I have this as 11 years, but you can go back. It's the highest I have on recorded basis. I'm not saying that's wrong. I'm not saying that the markets are right. I'm just saying what you're paying for in terms of earnings growth is incredibly high. All right, there's your discount rate. That's what I was just talking about it. And you can now see that because the discount rate's gone up so much since kind of mid 2020, that the growth rate also has to go up. It's the required growth rate effectively to justify the current valuation. That's how much NOPAT has to grow on an annual basis to justify the current valuation. And because rates have gone up so much higher, that hurdle rate is so much higher. So it's interesting that if you look at it as a percent of enterprise value, we're at a peak that's similar to October of 2022. I keep saying that. Sorry about that. But if you look on a growth implied growth rate, it's significantly higher than we've seen in a long time. All right, and there's your 12-month moving average. So obviously it's higher than that since it's been trending up. Here's a short histogram where I looked at annual growth rates back monthly, and you can just see this is similar. We're at a very high, far right part of the distribution. All right, now there is another way to do this same thing. You get the same result, but it's kind of cool. And that is you can just start with the original equation, enterprise value equals NOPAT divided by R minus G. Don't introduce enterprise earnings power value at all. Just play with the equation the same way we did, flip it, and now we're going to be able to get growth by itself. And now different equations, same conclusion. This says growth, same growth, long-term perpetuity. It's a perpetuity NOPAT growth rate is equal to R minus NOPAT divided by EV. So it's the discount rate, the required rate, minus essentially a NOPAT cash yield, which is sort of an inverted cap rate, but that would be your implied cash yield. And that sort of makes sense, right? The discount rate is the required rate, and the NOPAT cash yield is sort of the cash yield I'm getting. Growth has got to be the difference between those two. I've got to make up the difference. I'm only getting a certain cash yield at the moment, and I need more, an R that's greater than that. Now, because this is a perpetuity growth rate, we can also deal with higher growth at the moment. All right, so there's the two formulas. They get exactly the same number. G is the same in both equations. The top one, you're using the market implied value of growth. The bottom one, you're using essentially a cash yield. As a lot of people say, an inverted PE, right? It's very similar. I'm going to make that connection in a minute. I prefer the first equation because I'm often thinking about what percent of the valuation is made up of growth, value of growth. I'm a big growth guy, and therefore the first equation is the one I really like, but they both are, I think, very powerful and very helpful. All right, now that EV to NOPAT is kind of a PE. No, it's not a perfect PE, but it's a multiple of a type, and we can use that insight to actually have, I think, what I think to think of is translate this work into PEs, at least a rough approximate. All right, so here's two what I think are incredibly cool equations. I'm going to walk you through it because at first glance they look confusing, but in reality they're trivial. Top equation says that a PE, the current PE, now I think you got to look at a cleaned up PE, clean up those earnings, minus 1 over the cost of capital divided by the PE that's the first part of the equation. We'll come to the second part in a minute. So it says effectively take your PE, subtract off 1 over the required rate, which is an inverted required rate. It's kind of a no growth PE, hint, hint. Subtract that from your PE and divide by your PE. So what percent of your PE is not accounted by your no growth perpetuity PE? A no growth perpetuity PE would be 101 divided by the cost of capital. So what part of the PE is not your no growth PE, which is obviously I'm headed to, is that what parts of your PE are effectively assigned to growth. So let's go through an exercise. Let's just say that cost of capital is 10%. So 1 over the cost of capital is 10. I have a 20 PE, so 20 minus 10 on the top divided by 20, that's 50%. Let's go a little higher. Let's say we have still the cost of capital is 10 and my PE is 40. So 40 minus 10 is 30. 30 divided by 40 is 75%. So it's kind of a cool way of thinking about the market implied value of growth for a PE. And since a lot of people deal with PEs in the investment world, I think this is kind of a fun way to think about it. So take your PE, minus one over the cost of capital. If your cost of capital is 8%, then that's going to be the equation on the right, on the top on the right, is going to be 12.5. And then take your PE. So the first part of the equation is just the percentage of the PE accounted to growth. The percent of the PE not accounted to that perpetuity, no growth PE. Now multiply that by your cost of capital, and that's the market implied expected growth rate. This is where it gets kind of fun. If you take the same equation on the left and you multiply that by your expected return, what you want to get in the stock, that's your estimated growth rate. So if the cost of capital is 10, but you think you're going to make 15% in the stock, then you obviously need a higher growth rate. So these are kind of fun equations. I'm going to use these momentarily. All right, so now here's something to put together a little table. I'll leave the chart up for a moment so people can see it. But if you have a cost of capital on the left and you have a PE on the right, you can calculate what percent of that PE is for growth, the market implied value of growth percentage of the PE. So if you have an 8% cost of capital and a 20 PE, guess what? 37.5% of that PE is attributed to growth. Now, if you have a 10% cost of capital and a 20 PE, guess what? Shocking. 50% of the PE is for growth. And then we did one, I think we did 10% cost of capital. And what did I have? I had a 40 PE I don't have here, but a 10% cost of capital and a 25 PE, guess what? 60% of your value is based on growth. All right, now what we can do from there is, if you have your cost of capital and your PE, we can have an implied perpetuity growth rate, earnings growth rate. So lay that out. That's fairly simple. Once you have the first table, this is fairly simple. If I have a 10% cost of capital and a 20 PE, the implied perpetual growth rate is 5%, which is that 50% times 10%. All right. What it can also give me is cost of capital and your PE. I can tell you what the implied PE from growth is, which is not, I think it's kind of cool because you can stop and you say, I have a 10% cost of capital and 19 PE. 9 points of that 19 PE are for growth. I think it's kind of fun. What's my PE for not growth? 10. What's my PE for growth? 9. What's my total PE? 19. It's kind of fun. And then, of course, the implied percentage of that PE from growth, this is going to be obviously exactly the same as we saw a moment ago, but that's just another way of thinking about what part of your PE is from growth, what part of your PE is just from steady state. And a lot of people live in the PE world, so I like to translate the market implied value of growth, the value of growth work into the PE world. All right, now this is just a quick equation. So PE is approximately equal to your NOPAT cash yield plus your market implied value of growth. That's the way you want to think about it. So if you think the PE should expand, by the way, then you're essentially, and nothing's changing in your NOPAT, is obviously the growth expectations are going up. So you can kind of play with this. If the earnings power value goes up, then that's that first equation. That can also drive a higher PE, just so you have it. All right, I think, I ended there. So thank you for watching. We've got lots more to come. I'm going to keep diving into this whole equation and the use of it in the next couple of videos. I appreciate you following along. Thanks, bye.